take the best of IFRS that's available for us. So before we understand what should we do as accounting professionals in the new 2022 India, we should try to understand where does IFRS come from? What was the need for having IFRS in the first place? All right. So once we get past all those few initial fundamentals, we'll be able to proceed with how do we have to actually use IFRS, what are its benefits, certainly the setbacks and drawbacks under the Indian context. And once you have those sorted out, we'll pretty much be covering the entire implications of IFRS, right? So let me quickly begin with the PowerPoint presentation that you can see right over here on the side behind me. I hope you can all see it. If you can, please drop in a yes in the chat window. It'll affirm that, yes, it's all visible to all of you. And of course, if my voice is audible and clear, please let me know that as well. Thank you for the confirmation. I've seen a couple of them. So thank you very much. I think we can begin with the session now. So the very topic of IFRS seems to be foreign to us. Initially, when IFRS was in the blooming days in 2010, 2011, it seemed that it is not relevant to the Indian context and that we already had our own IFRSs, right? So what was the need to have a different IFRS? Well, I've broken down today's agenda and discussions into these 7 different agendas. 7th one is not particularly an agenda, but 6 different topics, which once we're done in the next hour or so, you'll have a very clear idea as to what was IFRS, what was the need to have IFRSs, what is the implication of IFRS, and what can we do ahead to make the best use of the IFRSs, all right? So stay with me for the next hour or so, and if you have any questions, we'll try to take up those questions towards the end in the conclusion section, and we'll see that all of your queries are addressed, and if it's a technical query, we'll try to address them, but if it's anything to do with the Indian context, certainly we'll try to pick it up right now. The very first topic is Introduction to Global IFRSs. So we'll try to understand what exactly is the IFRSs, all right? A very quick introduction, and then we'll proceed with the other topics. So number 1, what was the need to have IFRSs, right? So companies, as you know, operate worldwide, and it becomes compulsory for companies to adopt a uniform single set of accounting standards, a standardized practice that is international financial reporting standards in our case. IFRS is set of a high quality, understandable, and foreseeable. By the term enforceable, I mean you can legally take it up to the court for non-compliance. And it is globally accepted principle-based accounting standards. So what do we mean by principle-based? So there are 2 types of accounting standards, actually. We have a rule-based accounting standard and a principle-based. A rule-based accounting standard is the one where any changes or amendments that happen in the industry, particularly in the accounting or taxation industry, are accommodated as a new revised rule that is added to the existing bundle of rules. In a principle-based accounting standard, the original accounting standard that was drafted itself is changed. So you don't keep adding new rules as and when there's an amendment. Instead, you change the fundamental principle, the actual set of accounting standards. Yes, please. Was that a question? All right, I think we'll continue. So a principle-based accounting standard is the one where your original accounting standard itself is changed, probably by adding some new clauses to it or some new paras, but you're not adding a new set of accounting standards to itself. US GAAP is a rule-based accounting standard, unlike IFRSs, which is a principle-based accounting standard. So what's the need to have IFRSs internationally was that it acted like a common playground for better understanding of accounting. It created comparable and more transparent financial statements. It also helps to synchronize accounting standards across the world. If you talk about South Africa, they adopted IFRSs. You talk about Canada, you talk about UK, most of the European countries and the North Atlantic, the North American companies These entities have adopted IFRSs, and now they are able to synchronize their financial reporting across the globe. This means if there's any investor or stakeholder who's sitting in the US, will be able to read the financial statements of UK without any setbacks or hesitations. India used to have a different set of accounting standards. So the treatment of every line item that you see on the face of the balance sheet or perhaps in the profit and loss statement, even for the biggest of the companies that we have, I'm talking about the top group A companies like Reliance or TCS, Infosys, etc. Even their balance sheets were as per the Indian accounting standards, which made it a little difficult for the investors abroad to understand what exactly is happening in this company. And this was the situation abroad, that they were able to synchronize and understand in a uniform fashion what's going on with the companies that they are trying to invest into. It also increases foreign investments because of this very reason. And you know that once you increase the foreign investments, we obviously have industrial growth, then we have disconnect in the barriers. Those barriers or setbacks are completely removed because we have a good flow of information and easy understanding. So there was a need for IFRSs. So once we have understood why internationally IFRSs were required, let's try to understand what IFRSs comprises of and what are the four statements actually that IFRSs comprises of. Just like in India, we have accounting standards guidance notes, right? So these are guidance notes are provided by our mother body ICAI, which actually constructs these accounting standards in consultation with the government. And guidance notes act as a supplement to the actual accounting standard that is notified in the official gazette of the government. Just like the guidance notes and the accounting standards, in the IFRSs, we have four different statements. The first statement is International Accounting Standard, or which we'll be referring to in the next hour as IAS, all right? IAS is just IFRS, but a different prior or predecessor name to IFRS. Then we have, of course, the IFRS, or the International Financial Reporting Standards itself. The third set of documents in the IFRS is standard interpretations. Interpretations are also official documents that are issued in conjunction to these standards and probably add as a supplement so that the other standards are better understood in areas where there is a slight confusion as to what should be the applicability and the treatment of certain items. And lastly, the fourth statement that we have is International Financial Reporting Interpretations, or IFRI. All right, so these are the four set of statements. These are like the laws. They are the statements that define and give the comprehensive overview of the entire IFRS. Then we have the governance machinery, right? And governance machinery is the set of regulatory bodies, the statutory bodies that construct, issue, and guide the development of the IFRS. And not just till the development, even after that, if there's any changes required, then they collect the data from the industry, they give it back to their statutory bodies for research purposes. If at all there is any change in the principle that is required, is done basis these studies. So the first governance machinery, the topmost mother body for IFRSs, is International Accounting Standards Committee Foundation, IASCF, and that is the body whose function is to simply oversee the international accounting standards, all right? Not the IFRSs, the IASs. The second body is the IAS Board, or International Accounting Standards Board. Now, IASCF, or the Committee Foundation, used to oversee the IAS. The IASB, or International Accounting Standards Board, sets the IFRSs. International Financial Reporting Interpretations Committee is the third governing body. So we can put a short for it as IFRIC, International Financial Reporting Interpretations Committee. And their job, the IC Interpretation Committee's job, is to be responsible for interpretation of standards and issue guidance on issues that have not yet been addressed by those standards. For example, we had IAS 41 on agriculture. So that tells us about the treatment of agricultural income. India, as we all know it, about 2/3 of their income, of our income, has been up to very recently dependent on agriculture. And yet, if you talk about the accounting standard that talked about reporting the agriculture income just came about just 10 years back. So you can imagine the setback that India used to have by not having a uniform accounting policy. Imagine a country whose 2/3 of the income is dependent on one source, and there's no accounting standard policy for that one source. Accounting standard for IFRSs and Ind AS, as we'll get into that eventually, for particularly agricultural income came about in 2010 or 11. And they were, to be put it bluntly, blindly adopted from the IFRSs actually. IFRS, particularly IAS number 41, used to talk about agricultural income. However, not all the items were treated. For example, if you have livestock, if you look at a balance sheet on the Indian, any of the Indian companies, you will never see a livestock as a fixed asset or a current asset item, right? Over there, livestock is also a depreciable asset. So you'll have to look at the fair value, you'll have to charge depreciation if it's required. All of those pointers were already placed in the IFRSs. However, if there were issues that, all right, you can't depreciate the livestock, so you can't put a value on it, just record it at the fair value. So instead of charging depreciation, simply do an annual exercise, and look at the fair value. And that's how the issue was addressed by IFRIC, Interpretations Committee. So this is the way that the Interpretation Committee looks into the industry and tries to see what are the possible changes that are required, and accordingly the IFRSs are changed. The fourth governance machinery, or the last body that we have, is the Standards Advisory Council. Now, this is a forum to provide broad strategic advice on IASB's agenda, priorities, and insights into the cost-benefit analysis. So you can say that Standards Advisory Council, SAC, talks about the cost-benefit analysis. The Interpretations Committee will tell, all right, there is some issues, we need some accounting treatment on that, so what should we do? The SAC will study whether this issue is large enough to implement a new accounting standard, or to perhaps change an existing accounting standard to revise it. In any situation, it will have to evaluate the cost benefit. And if it's costly, the cost exceeds the benefits, they'll certainly reject that project. Now that we know what is the governance machinery, we'll talk about adoption timeline across the globe. Now, adoption timeline will tell you how quickly has world got used to IFRSs. So far, you've understood that IFRS is not provided by any government. IFRS is constructed by independent bodies across the globe. IASB, IFRIC, SAC, so these are the bodies who are working together independently. But the standards that they are issuing are to be adopted by any company or country who feel that, yes, these are absolutely at par with our reporting requirements or regulatory requirements. For example, if we talk about the corporate governance standards, which are recently adopted in the Far East, and they were chartered and constructed in India. These corporate secretarial standards were adopted by Far East, probably it was Singaporean companies, I guess. In the Far East, they had adopted the Indian versions of the corporate accounting, corporate secretarial standards. So this tells us that regardless of whatever is the body that's constructing these standards, if a company or an economy feels that these standards will serve our purpose, they are free to adopt it. And that's what's happening with IFRS. Almost all of the countries feel that IFRS has put in place every single requirement that is at par with the compliance in their economy. And that's probably the reason why more and more companies across different economies are adopting IFRSs. So let's talk about the timeline. Who has adopted what so far? We talk about the European Union, which had Britain, before the Brexit, we had Britain as a part of the European Union. The European countries had adopted it all the way back in 2005. and Canada 2011, USA 2016. Even USA has adopted 2016 IFRSs because although they have the US gaps, their corporations had become a lot multinational. Their companies were being listed on foreign stock exchanges, etc. They had a huge exposure, interconnectivity across the globe, right? So USA also adopted those IFRS standards all the way, I would say, 6 years back in 2016. Japan, too, has adopted IFRS in 2016, Nepal in 2011, Brazil 2010, and India officially 2016. If you look at the statistics globally, total 144 tax jurisdictions across the world out of 195 countries that are existing today, 144 jurisdictions have adopted IFRSs officially. So these are the standards that are prescribed and laid out to the world by the IASB. It is up to the individual economies as to whether and how to adopt them, depending on the scale of their business exposure to the outside world, that might warrant them a uniform accounting practice. And of course, we've talked about what is the need for them to adopt in the very first topic, right? So let's have a look at the number of standards that are in place, and then we'll get to the Indian context and implications in India. If you look at the number of standards, as of 2022, we have 17 IFRSs issued, and the most recent one was IFRS 17 on insurance contracts that was drafted in 2021. However, because probably of the pandemic or whatever reasons, it was moved to be implemented from 1st January 2023. If you talk about the IASs, we have 29 IASs in place as of today. So we have the last IAS being IAS number 41 on agriculture income. If you talk about the international accounting standards, they were issued by the predecessor body, that is International Accounting Standards Committee, between the years 1973 through 2001. And after 2001, everything is IFRSs. It's interesting to know that IAS, that is International Accounting Standards, is the same as IFRS, all right? IAS and IFRS are the same. Only difference is that before 2001, IFRSs were referred to as IAS. And after 2001, the IAS board has stopped issuing IASs, and now every new accounting standard that they issue is IFRS only. So before we get into how has the impact been, let's try to understand the legal side of it, right? So what's the current situation of IFRS in India? What does the law tell us about the IFRS in India? Currently in India, as of today, IFRSs are not permitted. To be very blunt, IFRSs are not permitted in India. Ind AS, or Indian Accounting Standard, which is a revised form of the IFRSs adopted and tweaked, changed from the Indian perspective, is what is suitable for India and adopted by India. The Ministry of Corporate Affairs, or MCA, in its February 25th, 2011 press release, had notified about 35 Indian accounting standards, or Ind ASs, which were actually just a converged form of the IFRSs. And they were referred to as draft Ind AS. 4 years later, after 25th February 2011, on 2nd January 2015, again, the MCA, or Ministry of Corporate Affairs, issued a phased implementation. And now you must have all heard about the phased implementation, right? Phase one, we had a group of companies that were compulsorily required to have the IFRSs. A phased implementation was issued on January 4th, 2015 that outlined the various phases in which the Indian accounting standards had to be converged with the IFRSs or draft Ind ASs. And it was proposed to be implemented in India for companies except banking, insurance, and non-banking financial companies, or NBFCs as we call it. Consequently, the companies would require to convert their Indian accounting standards to IFRSs or the draft Ind AS. And that was placed right in the press release of 2nd January 2015. So right in 2015, the MCA had shown their intention very clearly that eventually the companies will have to comply with IFRSs. However, like I said, IFRSs are not allowed in India they are converged into something called as Ind AS, and Ind AS is what is applicable to India. So who does it apply? The phased implementation decides who does it apply to. The very first phase came out on 1st of April 2015, where all the companies across India, we have currently about 12 to 14 lakhs, right? About 12 to 14 lakhs companies, at about 1.5 million companies that are registered in India. Back in 2015, all the companies had the option to voluntarily adopt Ind AS, not the IFRSs, Ind AS. Mandatory application or compulsory applicability of IFRSs, that is Ind AS, came to all companies from 1st April 2016, provided that these companies who were required to have the IFRSs in the form of Ind AS should be a listed company, or it could be an unlisted company, but it should have a net worth of more than or equal to at least 500 crores. Now, net worth is computed as the shareholders' funds that comprises of the equity and the reserves added to the equity. Only if you had 500 crores can a listed company or an unlisted company can apply for Ind AS. It should compulsorily go for the Ind AS. To compute that net worth, you don't have to look at the current financials, you have to look at the past 3 years' financial statements. Then came the next phase from 1st of April 2017. It provided that only listed companies or companies that are in the process of being listed have to compulsorily go for Ind AS from 1st April 2017. And now the net worth requirement was brought down to 250 crores. So if their total net worth from any of the period, it's not all the periods, it's any one of the years, 4 years in the preceding previous years, any one of the years had a total net worth of about 250 crores, well, they had to go for the Ind AS, and that's compulsory. That's a compulsion. It's a law. So there was no voluntary option given to these companies. And after that came phase number 3, where we had compulsory applicability of Ind AS to all banks, non-banking financial institutions, and insurance companies from 1st of April 2018, right? So 2015, all voluntary, 16, 500 crore net worth, 17, 250 crore net worth. Then came 18, where banks, NBFCs, and insurance companies. Now, in India, banks, NBFCs, and insurance companies are not just governed by the company law or the corporate charter that we have. They are also governed by independent banking laws and IRDA regulations, right? So there are 2 sets of governing statutes that are applicable to these kind of companies. And that's the reason why these companies have to prepare their financials in a specific format. If you look at the laws in India, most of the laws would sideline all banks, NBFCs, insurance companies as a separate set of corporations, and the normal domestic or international companies, foreign companies, as one set of companies in a different. So this different set of companies will have to comply as per their local regulations. That is the IRDA. We're talking about the banking laws. And from 2018, they needed to have a net worth of at least 500 crores or more if they had to comply with the Ind AS. Now, Insurance Regulatory and Development Authority, that's IRDA of India, had to notify, all right? Even despite this notification by the MCA, the IRDA had to notify a separate set of Ind AS for banks, insurance companies that would come in effect from 1st of April 2018. So for example, if you have 41 Ind ASs, out of that, the IRDA will tell their companies, the insurance companies, look, you have to comply with these 5 Ind ASs in particular. Only those companies that had a net worth of 500 crores or more from 1st of April 2018. Once again, the net worth had to be checked for the previous 3 financial years. So if you triggered the net worth of 500 crores in any one of the financial years, you had to comply with the Ind AS for insurance, banking, and NBFCs. And then came the last phase, which is phase number 4, where all the NBFCs whose net worth was at least 250 crores had to compulsorily comply with the Ind AS from 1st April 2019. So if you look at the summary of the positions, the clarification on the position today will be that voluntarily, yes, all the companies have the right, even a private limited company with a small turnover has the right to go for Ind AS. Mandatorily, that's compulsorily, NBFC 50 crores, banks and insurance only if they have a net worth of more than 500 crores, and listed companies if they have a net worth of 250 crores or more, unlisted if they have a net worth of 250 crores or more. That's the situation as of 2022. Some important considerations also had to be done other than the legal implications that we have, not the implications, the explicitly stated laws and the current implications that we have seen. Other than that, there are some more pointers that are to be understood in the form of applicability of Ind AS. Number one is that Ind AS will apply to both consolidated and also to standalone financial statements if you're talking about holding company, subsidiary company accounts. So all the companies have to comply. And this is helpful as companies will not have to maintain, dual sets of accounting systems. They can simply follow IFRSs even for the subsidiaries or the holding company together. If the Ind AS becomes applicable to any company, then automatically Ind AS shall be applicable to all its subsidiaries, holding companies, associates, joint ventures, irrespective of the individual qualification of that company. So even if the company has a turnover of 1 rupee, if their parent company has a turnover that exceeds the limits required for Ind AS, or probably they voluntarily opted for the Ind AS, the subsidiary will also compulsorily have to prepare their financials using the IFRSs in the form of Ind AS. If we talk about the foreign operations and overseas subsidiary, associate, joint venture of any Indian company is not required to prepare Ind AS based financial statements. So if you have an Indian company with any connection abroad, that abroad connection is not required to comply with the Ind AS. Instead, the abroad connection that they have may continue to report as per their local jurisdictional requirements, right? However, these entities will still have to report their Ind AS adjustment entries for their Indian parent company at the time the Indian parent company prepares a consolidated statement to be reported to the Indian government. So you don't have to prepare that only at the time of consolidation and presenting the overall financial operations position to the Indian government. That's when these foreign operations have to comply with the Ind AS. If you talk about the IRDAs and NBFCs, we've talked about that as per the phase 3 and IRDA's rights to enforce the Ind AS, it appears that insurance companies, banking and non-banking financial companies shall not be required to apply Ind AS either voluntarily or mandatorily. I repeat, as per phase 3 and IRDA's rights to enforce the Ind AS, to make it legal, it appears currently that insurance, banking, and NBFCs shall not be required to apply Ind AS either voluntarily or mandatorily. However, it also appears, though it is not yet clarified, that if these entities are subsidiaries, joint ventures, or associates of particular parent company covered by the roadmap, then they'll have to report Ind AS adjusted, just like we've talked about the foreign entities converging to Ind AS at the time of the final consolidation reporting. So when Ind AS are in conflict with any local regulations in India, then the local regulations in India will prevail over the Ind AS. The laws will prevail over Ind AS, right? So that's one of the other pointers. Other than this, SEBI itself has come out with specific set of guidance for Indian companies. So all those issuer companies who want to be listed on the stock exchange and who have already offered or given their offer documents, to be filed to SEBI on or after 1st of April 2016, except for rights issue. So we're talking about the IPOs. SEBI has issued a clarification for the applicability of Ind AS on this company and made it compulsorily for them, if they're under the process of listing, except for the rights issue, to have complied with Ind AS at the time of application. Typically, SEBI requires issuer companies to disclose financial information for the previous 5 financial years preceding that time of filing the offer document, while following a uniform accounting practice in every single year. So those companies who are issuer companies and intending to file the offer document should keep in mind that number one, up to 31st of March 2017, all the financial statements that will be filed, that would have been filed by them, would have to comply with the local Indian accounting standards that were issued by ICAI. However, after 1st April 2020, disclosures in all the previous 5 financial years will have to be made as per the Ind AS. So if you have a company who is intending to get listed other than the rights issue, it will have to comply with Ind AS for all the past financial year. And this is an official clarification given by SEBI. All right. So let's proceed with the slides over here. Let's talk about general financial reporting implications. So general financial reporting implications is the revised format of the balance sheet that we have in IFRSs. Instead of calling it a balance sheet, they refer to the term as statement of financial position. It's right there, as you can see, SOFP. Statement of financial position will tell you exactly everything that's there on the balance sheet. You'll have notes to the statement of financial position. Only one difference that Indians have to keep in mind when we are adopting the IFRS is that the current item classification is a little different than what we used to do in the erstwhile accounting standards. An item will not be classified as a current item if it is payable or receivable within 12 months. Excuse me. An item will be classified as a current item if it is payable or receivable within 12 months from the end of the accounting period. Excuse me. From the end of the accounting period, or whose operating cycle is more, whichever is more. So instead of having a 12-month as the cutoff mark for classifying items as current and non-current, we'll now classify the items as current and non-current depending upon the higher of the length of the operating cycle or 12 months from the closure of the financial reporting, not the date of the transaction. Whichever period is longer will be deemed as the period for cutoff to treat items as current or non-current. If we talk about the statement of income, it'll include everything from the manufacturing gross profits to the reporting operating profits or the net profits, just like we prepare in India, the same way that we prepare every single line items. In the manufacturing cost, you have the operating, non-operating costs. Everything will be included. Even discontinued operations net of taxes will be added to the non-operating expenses. Until 2018, there was an amendment where we were allowed in the IFRSs to include unusual and infrequent items that we call extraordinary items, right? Unusual and infrequent items were supposed to be reported separately, but well, that too was moved to non-operating from 2018. So statement of income is, you can say, absolutely the same like India. Then we have a new statement, which is called as SOCI. SOCI is also supposed to be filed. Now, remember, these are the 5 documents that you have to prepare every time. So once your financial reporting period is over, you'll prepare these from the reporting entities. Your auditors will check these. Then whatever queries are raised by the auditor to the board of directors will be addressed by the board in the general meeting. And these 5 sets of financial statements will be adopted by the shareholders in the general meeting. Unlike in India, we have about 4 of these. Over here, we have 5. But if you look at it fundamentally, you'll see that the 5th statement too is just what we've been doing in India so far. SOCI stands for Statement of Other Comprehensive Income. And in the SOCI, you can think about the SOCI as an extension to the Statement of Income. There are 5 particular transactions that are to be reported in the SOCI, only 5, which relate to the pension adjustments we have available for sale securities transactions, so AFS as they call it. So any fluctuations that happen in the AFS are also to be reported. Remember, in India, we don't do that. For example, if you've invested in some equity or any other shares, you show it as a current investment at the value at which you have invested. You only restate it to the fair value or the current market value if you're trying to sell it today, right? Only then you'll book the profits. Otherwise, on the balance sheet, you don't show that this is the market value. You don't show appreciations every balance sheet. You only appreciate the values if they are being sold. Over here, you have to show appreciations at every balance sheet because IFRS believes that this has to present a true and fair view. Although if you ask me personally, well, this goes against the accounting fundamental of conservatism, right? Because in conservatism, we tend to book items that are, we book losses and not book the profits. So that's what we do in conservatism, which is a stark contrast to what the SOCI statement is. However, IFRS prescribes that, and it has to be prepared. Number 3 is we have currency translations, and there's a particular method called current method, which is used for that. Number 4, we have number 4 is reclassification of any impairment, intangibles and fixed assets upward. So if you have any upward revaluation of intangible assets or even fixed assets, well, that too has to be a part of the SOCI. And the last statement is effective portion of derivative of cash flow hedges. So that's one of the items that is supposed to be also presented in the SOCI, which is not particularly done in India. Then we have another statement called SOCE, or Statement of Changes in Equity, which is similar to an account called P&L appropriation that we prepare over here. Now, this SOCE account will only tell you the differences of changes in the equity. In the respect of raising equity capital, you will add to the SOCE if it's an issue of stocks or stock dividend or bonus shares, as we call it, stock dividends equal to bonus shares. And in that case, you will show it as a reduction. If you have issued cash dividends, you will show it as a reduction from the reserves. Reserves balances will also be shown in the SOCE. So it will only talk about the wealth of the shareholders and the fluctuation. SOCE is a reconciliation of the opening and the closing balances of the changes in the equity. And last, we have the SOCF, or Statement of Cash Flows, which we also prepare over here, right? Cash flow statements, as per the IFRS, particularly IAS number 7, allows both the methods, that is the direct method and indirect method of cash flows. Both are allowed. Cash flows are those statements that are not an integral part of the statement of financial positions or income, but they are annexed to that set of financial statements. And they are annexed because they are just shown as an addendum. The balance that appears at the end of the cash flow statement necessarily has to match with the statement of financial position cash balance that appears under current assets on the balance sheet. That balance and the SOCF closing balance have to tally. That's the only new information that we need to know about the reporting. If you look at the specific financial reporting implications, there are several implications in India. If you look at the inventory valuation, currently under the Indian GAAP, what we used to do is valuation of inventory is not based on the nature or use of inventory. Valuation should reflect the fairest approximation of the cost of the inventory. In the IFRS that is converted to Ind AS, valuation is based on the nature and use of inventory. And exactly the same cost formula that we have will be used for inventory valuation having same nature and use of stock. So if at all you have a particular class of stock and a nature of inventory line, in that case, they have to comply with the same inventory valuation method. We are talking about FIFO, LIFO, weighted average. And it's interesting to note that IFRS particularly prohibit the LIFO method. So if you're adopting it into India, LIFO will never be used. It's only FIFO and weighted average methods. So you check what kind of stocks do you have, what is the nature of the stock. Depending on that, you have to create a valuation. But in India, what we used to do is whatever is the money that you have spent in creating that stock that you'll be reporting on the balance sheet is what is picked up to be a part of the inventory valuation. If you talk about the cash flows, where AS3 is what governs the Indian cash flows. In AS7, we've just discussed the cash flows, right? In AS7 talks about the cash flows over there. If you talk about the bank OD in India is treated as a financing activity. However, under the Ind AS, bank OD will form an integral part of the entity's cash management and is categorized under cash and cash equivalents. So CCE that we report under the current assets. If you look at the cash flows from extraordinary items, in India, what we used to do was cash flow from extraordinary items are classified under financing, operating, investing, whatever may be the case. However, under the IFRSs that are adopted in India, cash flow statement is not permitted to record extraordinary items. So there's no such classification in the in the IFRSs. If you talk about the PPEs, property, plant, equipment, AS6 that we have in India, depreciation accounting, is what was being used to report the property, plant, equipment, or the fixed assets. However, if the IFRSs are implemented, the IND AS number 16 that deals with property, plant, and equipment will come into picture. And there's a slight change in some of the paras because of which the entire standard is supposed to be adopted. And you have to read the standard before you adopt it, but we won't be getting into the technical details. If you talk about the foreign currency, AS11 is what we use to refer to affect and account for the changes in the foreign exchange rates. In the case of IFRSs, it's IAS number 21. That's International Accounting Standards number 21, the one that was issued before 2001. The effects of these changes will have to be reported in accordance to that. If you talk about the replacement cost, well, replacement cost is treated as an expenditure as and when it is incurred in the current Indian context, right? So all those companies that are not complying with IFRSs, for them, replacement cost will only be recorded in your books only when you incur that expense to buy the asset or replace the asset. However, replacement cost has a specific definition in IFRS, which has a specific valuation method. We have three terms associated with it, which are called ceiling, floor price, market value, all those definitions. And it's a complex calculation just to report the asset and capitalize it at the replacement cost. If you talk about the EPS, currently in India, we follow AS20 for the EPS for non-IFRS companies. For IFRS companies, IAS 33, that's International Accounting Standard 33, has to be followed. Some of the paras are different. And in terms of disclosure of EPS in separate financial statements, all financial statements of the parent company should disclose basic plus diluted EPS in current Indian context, right? So currently that's what we're doing. All the financial statements of the holding or the parent company, both of the EPSs have to be shown. However, if you follow IND AS, that's IFRS, only consolidated financial statements will have to disclose the EPS. Standalone financial statements have the option whether or not to disclose it. Compulsion is only for the parent. If we talk about intangible assets, India, we follow AS 26 for intangibles. For the IFRSs, you have to follow IAS 38, which is just a verbatim replication in IND AS 38. If you talk about the measurement of intangible assets, in the current Indian context, we value or measure the intangible assets on cost only. But in the revised or the IFRS scenario, you'll have to measure it at the cost or even at the revalued amount. So this is something that's interesting. If you look at the impairment values, right, that's a sudden fall in the value of the assets. We don't do that unless we have sufficient evidence that the asset has in fact impaired. And a similar treatment is also given in the US GAAP, but the IFRSs will allow you to reverse that loss. So if at all, tomorrow, an asset that is already impaired and brought down, if tomorrow their values goes up, in India and even in the US GAAP, we don't use to bring it back up. But the IFRS allows you to do that. It allows you to revalue upwards back. And that's an interesting, once again, something that's against the conservatism principle, but that's an interesting treatment that the IFRS exclusively allows. So these are some of the specific issues. Let's talk about what do we have as opportunities in India, all right? So what are the economic benefits or economic opportunities in India? Well, number one, as the market expands globally, the need for a standard accounting standard, a globalized accounting standard also increases, right? And implementing this growth further, it facilitates whatever is the maintenance of orderly and effective capital market transactions and also helps to increase the capital growth, which eventually increases our economic growth. From the investor's perspective, investors from abroad who are willing to invest in India will want more information which is relevant, perhaps timely, reliable, comparable across different jurisdictions, all right? Financial statements that are prepared using the common set of accounting standards will help these investors in better understanding whatever opportunities lie ahead of them. For better understanding of financial statements, global investors have to incur more costs in terms of time, effort, money to get these statements converted in their regional or local jurisdictions. Imagine a corporation who's trying to invest millions of dollars into India. Obviously, they will have to spend a good amount of time and money in understanding the reports. They will require the exact revised structural report before they make the investment. Instead of that, if India is already adopting IFRSs, they'll happily just look at the Indian statements and immediately cut all those translation exercises and directly go for what is their own their own investment strategy that they have in plan for India. If we talk about the industries, then a major push will be towards implementing the IFRSs, particularly from the industries. And the reason being that the industry will be able to raise capital from foreign markets at a much lower cost if it can create that confidence in the minds of the foreign investors that the financial statements do in fact comply with globally accepted standards. Moreover, if you have diversity in different countries face a multitude of accounting requirements, and the burden of this reporting will be lessened when there's convergence between the accounting standard, because it simplifies the process of preparing group financial statements and also reduces cost. If you look at the cost aspect, the implementation of IFRS will certainly result in a reduction in the cost, not an increase. Like some people might perceive that IFRS implementation is a separate exercise and it'll increase the cost burden on the companies that want to comply. It's in fact the opposite. The cost reduction will happen because it increases the confidence in the mind of your investors and also reduces the burden of financial reporting whenever you want to expand, and simplifies the process of preparation of individual or standalone or group accounting. Moreover, IFRS will benefit the accounting professionals also, because they can now sell their accounting expertise worldwide, and this will result in increased mobility to work in the industry and practices also. Lastly, of course, it saves time and efforts, because if you adopt, it'll save time and effort for the management of the corporate to view all corporate or all group entity as one common platform. Then comparison becomes easy. Benchmarking of financial data with international companies becomes possible, because now you can look up to, for example, if you're a pharmaceutical company operating in India and your operation margin is say just 10-15%, you can compare your operation margin prepared using the IFRS statements with that of a foreign entity. If you look at the pharma giants in the world, you have AstraZeneca. No, I wouldn't think AstraZeneca is a giant, but if you have companies like Moderna, AstraZeneca, you have Merck, all those big giant players whose financial statements might be prepared with using the IFRS, you'll be able to compare their profits, what they are doing better than you, where are their resources coming from, and you as an Indian business startup or Indian entrepreneur, you'll be able to tell where are your areas that you need to work upon. So with the adoption of the IFRS, your investors can directly invest in efficient corporate globally, as they'll probably understand what the statements mean, what they try to tell. And because of this, ultimately, your foreign inflows will increase. So this that need to be addressed. So here are some of the challenges. Number one, the biggest challenge is people aren't aware. Although we've been hearing in the news accounting, we have our textbooks at the graduation levels across India, across different cities, and everywhere we have the IFRS as a part of it. It's all there in theory. We don't have the actual implementation. Very recently, ICAI has just come up with a couple of certifications on the IFRS, but if I can give you a personal example, back in 2015, when I was looking for understanding the IFRS implications in India, there weren't any resources, to be very honest. The only resource or official documentation that we had was that MCA notification that we just discussed, and it didn't really help because the Ind AS that were given were all given theoretically. So what is supposed to be done is something that you as a professional will have to read. It's a really good opportunity. When I did a little research, I came to realize that there's an institution called ACCA that's in the UK, and it's closely associated with the IFRS body. And in conjunction with that, in pursuance to that association, they had come up with the diploma in IFRS, and that similar certification also. And that's where you start to realize that, all right, there is a particular certification only for the IFRS course, which teaches you what is supposed to be done. So this awareness is just recently started in India. I wouldn't say it's on a large scale, however, it's still started. Certainly there is inadequate training. We don't have accounting professionals with the technical expertise will allow their time and, teach a mass level of people across India too. This is a good field, and I welcome all of you professionals out there that if at all you feel that you want to read more about it, it's a very small certification. You can look up, there are different certifications across the world. We have a few in India now. And once you qualify, you'll be able to guide your entire organization, the board of directors, to be compliant in terms of IFRS, and it'll also help you get an exposure internationally. So it's a very bright field, and we as Indians, we are able to give the language. The barrier that Chinese professionals have is mostly the language barrier, but we as Indian professionals, we are able to overcome that barrier very easily, probably because of our colonial background and the ability to communicate in the language of the world. This is a good opportunity, and if you look at the listings online, there are professional portals that provide opportunities for IFRS professionals with pays that's $80 per hour. So all you have to do is to go grab that certification. Then if you want, you can work freelance. You can also work in the education sector that you're currently doing, and also teach the next generation to prepare these professionals to be compliant with the IFRSs, not just to export their services elsewhere, but to also apply that to the income context. And the next challenge that we have is the continuous amendments and regulations, right? So this is something India is developing future economically. So amendments in regulations, excuse me, systematic manner, there is a need to do that. References are provided. And Income Tax Act 1961 is where references are also provided. And we have, all right, I thought the recording was paused for a moment. We are good. All right. We have the RBI Act, where certain references of IFRS are provided. We're also having other statutes that are associated with these, so that adequate changes will be made in the IFRSs. And it becomes a little tricky to track these changes, but then as a professional, that's what you're paid for, right? So you have to track the changes. So these are the only challenges that are currently existing. And the last one I would say is there's also a challenge in regards to the SMEs. So what exactly is the challenge in regards to the SMEs? In India, financial statements are prepared on the basis of ICAI standards, otherwise. And the financial reporting standard should be changed in a manner that it results in a proper implementation of the IFRS. It's even for the S and not just the 500 net worth or 200 crore net worth companies. There is a scarcity of resources and, of course, a lack of expertise for these small entities. And we have the most growing number of companies. So accounting professionals, if they are equipped with the IFRS certification, they'll be able to guide our own SME sector, which would surpass all the benefits of implementation and completely remove the challenge that we have. IT infrastructure is certainly a setback because enable to be able to produce these reporting standards, we must robust, consistent data for reporting. Line, we have tally, then we have a lot of new accounting systems that are in place. And information must be able to capture the new information, must be able to capture those new data that is supposed to be required. And the biggest challenge that's happening here is that principle of conservatism that we talked about in a couple of examples. Use of fair value measurements as a base is done in the IFRS. IFRS uses fair value, that's the market value base, to measure majority of the items in financial statements. And this brings a lot of volatility and particular subjectivity in the financial statements, because it will help to increase volatility in reported earnings and related performance measures such as EPS or price earnings ratios. True fair value results in gains or losses, which will be reflected in the profit and loss account. In India, entities which prepare these particular assets related financial statements do it on a historical cost basis. So this is where the biggest challenge comes, because as investors, we have already seen a number of scams in India in the past where fair valuation actually inflated the prices of the assets, right? Imagine you have a land, the purchase value of that land is just 100,000 rupees. But in today's terms, if you look at the land, the valuation would come about 1 million or 2 million rupees, or perhaps 200 million rupees. You don't know the actual value. Now, if you look at the balance sheet and inflate the values to the actual values, then this is actually misreporting in a sense. So this is absolutely against the conservatism principle. And that's where this becomes a little challenging for India, because investors will now look at your inflated assets and feel, all right, this is the fair value, so why should I not invest it? So this is one of the challenges that is there in IFRS implementation. And with this, we'll wrap up this session for the day. And it has been amazing